we typically like to give you a little bit of a visual effect first. So I'm going to ask Jeanette to show you a fairly recent video from our Kunming outlet. So over to you, Jeanette. Okay, I think maybe you have to give her a few more minutes while she loads up the video. Jeanette, are you ready to share the video? Apologies, I think we might be having a bit of a technical issue. Yeah, okay, here it comes. There's no sound on Jeanette. I can't hear the video. Apologies, everyone. Just bear with us for a few minutes. We're trying to sort this out. Yeah. Okay, in the meantime, I think we'll allow all more people to come in. Jeanette is still no sound. Okay, I tell you what, Jeanette, why don't we just in the interest of time, why don't we just go straight to the presentation proper? Then maybe if we have time, we can use the video for the closing. Yeah, shall we do that? So why don't we launch the presentation slides now? Yeah, thanks everyone. Slight apologies, but hopefully, towards the end, if we have some time, we'll be happy to show you this very interesting video on Kunming outlet. Okay, so let me just go straight to the presentation proper. If you could just scroll down, Jeanette, to the next page, page 3. Yeah, sorry, just go back to page 3. Yeah, so today we just cover sort of introduction about sassuer Group, which is a sponsor of the REIT, and then we'll talk about the highlights, and my CFO will take you through the financial performance, and our head of asset management will give you a bit more color about how the portfolio is performing, and I will close by just sort of in relation to some of the work plan for the rest of the year. All right, so if we go straight to slide 5. For some of you who are not so familiar with sassuer, the sponsor is sassuer Group. In China, they are known as 沙之船集团. Now, a couple of things I like to highlight for the benefit of all of you. First thing first, sassuer Group in China, they are not a property developer. So I think this is very important, particularly in current climate where property crisis continues to linger on. They are actually a pure outlet operator. So in a way, they really focus on the core capabilities of managing outlets, and they really are one of the top, best in class in the space in China. And in fact, on this slide, you will see, Vito Xu, who's the chairman of sassuer Group, and also he's the chairman of the REIT manager, and together with his wife Yang Xue, they have been credited with really starting this business and creating the platform over the years. So later we'll give you a bit more color in terms of how sassuer Group is doing in China. Next slide. Yeah, so in terms of sassuer Group, they have been in this business for a very long time, all right? But actually, if you look at particularly my chairman Vito, he has been in the fashion retail trade for decades. And this has served him very well when he brings that wealth of experience into the outlet operations. And today, Sassuer Group in China, they manage 17 outlets, including the 4 outlets owned by Sassuer REIT. If you look at the whole platform of 17 outlets, how they have performed, I think the numbers are actually very encouraging. For even year-on-year comparison, for first 6 months versus the 6 months last year, the sales is 8.8 billion renminbi, is up 6.3% year on year. I think this is very encouraging, particularly when we see consumption weakness still, the effects of consumption weakness are still quite visible in China. And later, you take you through some of the results for Sassuer REIT. And in terms of the brand relationship, they have 5,000. This is a very powerful database because that will help us in relation to how we continue to rejuvenate our outlets through new brands. And right now they have VIP members. What's VIP members? Later I'll get Xingwen to give you a bit of context of VIP members. And right now, the sponsor still holds a reasonably large stake in Sassuer REIT. So there is really a very strong alignment between the REIT, the sponsor, and the unit holders. So if I could just go down to the next slide. Now, this is the footprint of the sponsor Sassuer Group. One of those things I like to highlight is that you see our headline, that is asset-light business model. Now, what does that mean? I mean, this is a big word, but let me just break it down for you. When Sassuer Group started the outlet business, I would say maybe 16 years ago, they started by building their own outlets because, of course, they have to kickstart the business. So they built 6 outlets. And in 2018, they actually put 4 outlets under Sassuer REIT. So on their own balance sheet, they still have Xi'an and Guiyang outlet. And these two are, would say, the direct pipeline for Sassuer REIT because this Xi'an and Guiyang assets are still currently owned by the sponsor directly. Okay, then what happens to the 11 outlets still under management by the sponsor? This is what I call asset light because these are really just managed outlets. They don't have any. They have some of them. They have small equity stake, but majority is really there's just a management position, operations position. So in a way, it's asset light because this 11 outlets, they don't really have a strong asset position on their balance sheet. Now, this is also very important in relation to the capital outlay for the sponsor in relation to how they roll out more outlets. They are not going to try to buy a land and build and start putting large capital. And that also goes towards strengthening the financial position of the group over the years. So even during COVID, Sassuer Group remains financially very, very strong. And even today, with China's outlook, they continue to be very, very sort of selective in opening their new outlets. So you can see that in September, they are actually opening up one in Urumqi. And on this slide, you can see that they are actually going towards the first-tier city. So definitely, they continue to be sort of looking at the long-term fundamentals of China being good for the outlet business. So if I could just go, this is just encapsulate this super outlet business model for some of you who are not familiar. This is really, I would say, a very sort of proprietary business strategy for Sassuer Group, and they also sort of roll that out under all the outlets that they manage. So it's art and commerce. Commerce combined. So there's like a little formula here. Art times 1 plus N times DT. Okay, I won't go into specifics, but suffice to say, the way Sassuer Group look at their whole business model is really trying to redefine outlet beyond just the normal shopping. They really try to make outlet a lifestyle destination, and later you can see, we will show you the outlets are really full of activities, and also they bring in the super outlet concept to kind of differentiate themselves in the competitive marketplace, how they sort of be different from the competition with their super outlet concept. They have super outlet children, super outlet sports, super outlet farm, and we actually see some of this in our portfolio right now. Like in Hefei, we have a zoo, so this is clearly a more super outlet children concept, and as well as Kunming. Later we share with you how we are sharpening that super outlet business propositions in Kunming this year. All right, with that, I'm going to hand the time. Let me continue this section very quickly as well. All right, in terms of the first half results, I would say, is a stable set of results. All right. Notwithstanding that, the environment in China continues to be fairly choppy and challenging from month to month. If you look at our total outlet sales for the 4 outlets under sassuer, it's a slight drop of 3.9% year on year. I think there are still few factors. One of those that we recognize is actually the high base factor in 2023. But you can see in terms of operating metrics remain very resilient. Our portfolio is close to 98%. So it's actually a very high bar for a retail asset class. And the WALE is actually quite consistent based on historical trends. Now, how does that translate to the financials? We look at the EMA rental income. Actually, in renminbi, right, it's actually fairly stable year on year. When you translate to even Singapore dollars, despite the depreciation in renminbi still in 2024, I would say that rental income in Sing dollars also remain fairly stable. And DPU this year, we are delivering for first half year 3.153 cents. So for those who are not aware, this year we decided to move the distribution to semi-annual. All right, so this is also in a way we try to sort of smoothen out some of the DPU profile. Now, in terms of capital management, I would say probably we are one of the strongest in the marketplace right now with our gearing, one of the lowest, in fact, probably the lowest at 25.3%, and very strong financial matrix of 4.5 times interest coverage. And the debt maturity, we have no immediate debt, major immediate debt coming up for refinancing. So I think that will give us some time, in particular, to take advantage right now that we are seeing the possibility of a downtrend in interest rate environment. If going to the next slide. All right, so I think in terms of the 3.153 cents, of course, this is like a 5.1% dip year on year, but I would also like to highlight a few structural changes that have resulted in this impact. First is that from this year onwards, we have decided to collect 20% of our annual management fees in cash and 80% in units. In the past, we have always been collecting 100% of that management fees in units. So I think that will cause some adjustments to the DPU impact. And also, we also have a change in treatment of borrowing costs. Later, I'll get my CFO to mention this to you. So if we had not made those changes, right, this time around, in fact, the DPU would have gone up by 1.7%, right? So I think this is important information to illustrate that fundamentally in relation to the underlying strength of the assets and also how we continue to be very prudent in managing the total cost structure for the REIT, we can still deliver, I would say, a respectable set of DPU profile. So for those of you who are looking at maybe investing in sassuer, do take note that the record date is 6 September, and then the payment date for this dividend will be end September. All right, next slide. Yeah, I think, it's always important when we invest in REITs is really for the long term. So if you look at sort of the returns profile, if the total return is 32% from IPO till end of June. Again, I think this is actually a very, very good set of return, particularly if you compare that with the index. We have outperformed the index by quite a fair bit. And over the years since IPO, we have, together with this DPU that we're going to deliver 41.262 cents, we believe sassuer presents a really superior risk-adjusted return profile. If you look at this chart, what do I mean by that? Our yield, trading yield is 9.3%, but our gearing is the lowest at 25.3%. Based on SGX data, the market is now trading at 8.1%, but they are actually at a high leverage of 39.1%. So, in terms of risk-return profile, I think these numbers speak for themselves. And I would also like to highlight, actually, if you base on the first half year results in terms of share price performance, I think sassuer's share price has shown a very strong level of resilience. I think this chart you can see, no doubt it's down 1.5%. Overall, the whole REIT sector was still trending downwards for the first 6 months. But relative to the index, you can see that it has stayed relatively stable and fairly resilient. So with this, I am going to pass the time to Jianfeng.
Okay, thanks, Cecilia, and good afternoon, everyone. Now let's come to the financial and the capital management part. So from this page, a table below, you can see that in the first half 2024, outlet sales achieved RMB 2.2 billion, around 4% lower year on year. This is due to in first half 2023, China just recovered from COVID, and there was a pent-up demand in retail spending. My colleague Xuan will shed more light on this later. And the EMA rental income in renminbi for the first half increased by 0.9% to renminbi 329 million, which was supported by the 3% year-on-year escalation of fixed component of EMA rent. But in Singapore dollar terms, due to the depreciation of renminbi, the EMA rental income was 62 million, 0.4% lower, but remained quite resilient. The distributable income low year-on-year by around 3%, mainly due to what Cecilia just mentioned about the change of management fee in cash and also the change of treatment regarding amortization of upfront financing costs. And in the first half, the cash retention amounting to 3.4 million, which is 8% of the total distributable income. And above brings the first half DPU to 3.153 cents, down 5% year-on-year. Please note that our retention was made to partially repay the principals of onshore borrowings and also return for AEI during the year. So next page. And this page shows the detail of all the expenses relating to the first half. And also we focus on the table below. The key factors are, one is a REIT manager fee in cash. Impact was 0.9 million. And the fifth line is the amortization of upfront cost. The impact was 2.2 million. So adding this together, the total structure change was around 3 million. Apart from that, you might have noticed that we had some savings from our interest expenses of about 1.5 million. This was due to the majority of our borrowings are renminbi denominated, which can benefit from the renminbi interest rate drop this year. And also we have hedged the majority of our offshore debt with a favorable rate better than last year. And the other income dropped by 1.3 million. It's a result of non-recurring exchange gain incurred in first half 2023, which will not incur again. And also we benefit from the savings of the income tax, around 2 million, which was mainly due to the reversal of accrued provision for income tax in previous years. This is a recurring event, meaning that in the next half this year, we will still release another 2 million. And also from next year onwards, the tax expenses will be comparable to this year. Okay, so moving on. Now we come to the robust balance sheet as of 30 June 2024. Our investment properties value increased by 2% due to the currency effect, and with that, the NAV per unit was 85 cents, up 4% from last year. Next page. So in this slide, the chart demonstrated a diversified debt maturity profile. As you can see from the green color bars, our loan profile has been split into different maturity. The 1 year bar is the sponsor loan of renminbi 308 million. This is unsecured and fixed rate and to be mature in March 2025. The manager are now trying to seek cheaper debt in China to replace this, and the work is underway now. Apart from the sponsor loan, the other debts are syndicated bank borrowings with the offshore and onshore portion maturing in year 2026 and 2028 respectively. The bank loans are pledged with our Chongqing Liangjiang, Chongqing Bishan, Hefei outlet. So far, our Kunming outlet are unencumbered, and this presently us with further opportunities to optimize the debt capacity. And the chart in the left-hand side demonstrated the trend of China 5-year loan prime rate from 4.8% per annum in year 2020 down to current 3.85% per annum. And the most recent cut was just announced in July with a 10 bips cut. And this rate will be further trimmed by Chinese government to boost the economy. So given 53% of our total borrowings are renminbi denominated, so REIT will benefit from this trend. And the manager are now proactively seeking opportunities to increase the proportion of renminbi denominated debt, as currently renminbi debt is cheaper than the Singapore dollar and USD dollar rate. Also on the right hand side, you can see our hedging. The total hedging in this year is 87%, but different currency with a different hedging approach. For China onshore debt, we don't do any hedging because it's downward trending. For the USD borrowings, because they're actually very expensive, so we hedged 100% at a variable rate of 3.6% per annum. And also we hedged half of our Singapore dollar loans with a rate of around 3% per annum. So these rates are far below the prevailing spot rate of SORA and SOFR. And the hedge will be effective till the maturity of the tenor, which was March 2026. So next page. So next page. Okay, so the most important information in this page is about our weighted average cost of debt. So for this period, it was 5.3% per annum, dropped from 5.6% per annum. And given both China and US are on the path of lowering the interest rate, we could expect this cost will be further dip in the near future. And the sensitivity of DPU relating to the interest rates here for your reference. And you can see that the 10 bips cut of China 5-year PR in July 2024 will project 200,000 savings of distributive income per annum. And last but not least, we are now exploring more lending sources such as China Pounder Bond and offshore MTN program. But the priority is still the Pounder Bond as it's cheaper. Maybe you have heard maybe you've heard Capital Land and Shangri-La have issued a renminbi bond with interest rate of 2.5% to 2.8% per annum. And now we are working with the banks to check with the Chinese authorities regarding the Pounder Bond. We need to have their clearance before we kick off. And we will update you once we have any further progress on this. So with this, I end my session. I will pass to my colleague Xin Yuan to continue his part.
And good afternoon to everyone. I will present to you our portfolio performance in this section. And if you have any question, you can raise it in the pigeonhole later on. So in this page, it shows the first half 2024 portfolio sales. Even though on a year-on-year basis, it dropped by 3.9%, Chongqing Liangjiang outlet actually shows strong signs of recovery, with its first half 2024 sales surpassing the pre-COVID first half 2019 level by 4.6%. Year-on-year basis, on a portfolio basis, it is lower, mainly due to higher sales base achieved in 2023 after the Chinese government lifted all movement control measures in late 2022, which actually resulted in a revenge spending by consumers. So for Hefei outlet, it continues to demonstrate resilience, registering a positive growth of 1.3% amidst a challenging consumer market, mainly due to its effort to curate more popular young and trendy brands into the outlet is paying off. And of course, we brought in Yonghui Supermarket. The introduction of this supermarket has proved to be a strategic move, drawing in increased foot traffic from local residents seeking daily necessities. This has been translated into an overall boost of our sales. Next page. This one shows our diversified trade mix. Our trade mix has remained consistent quarter to quarter, with a significant trade mix that includes fashion, international brands, and sports. The trade mix accounts for approximately 62% by NLA and 80% by gross revenue. Our business mix is well balanced, which helps to mitigate any risk associated with concentration. The top 10 tenants contribute less than 15% of portfolio gross revenue, with no tenant contributing more than 5%. Domestic brands continue to grow in popularity. We continue to attract more emerging domestic brands to open stores in our locations. We also notice that the Chinese consumers now are choosing local brands for their quality, innovation, and not solely because of lower prices or from a sense of national pride. Next page. Okay, this page shows our occupancy level remains high above 97%. With an occupancy rate of 97.8%, we have once again managed to achieve success above the pre-COVID occupancy of 96%. This is a result of our outlets' appeal to existing and new brands, plus fruition of our asset enhancement initiative, both of which contributed to this positive outcome. The reason for the slight decrease in Kunming is the remix involving numerous tenants, which involve over 100 of them. This is part of our strategy to improve the leadership position of the Kunming outlet, which I will share more in a later slide. And our continuous active trade mix adjustment to replace weaker tenants with more well-known brands are paying off with this set of occupancy results. Next page. This page shows our weighted average lease expiry. Our WALE versus last quarter has remained stable at 2.1 years measured in terms of NLA and 1 year measured in terms of gross revenue. This is a result of a high renewal rate as well as new leases signed in this quarter. Then for those joining us for the first time, let me explain to you why our WALE are shorter compared to some other REITs. This is in line with our business model of rental taking a cut from sales. Longer leases is detrimental to our performance. That is, non-performing tenants cannot be terminated early to bring in new to market brands. A flexible leasing approach is adopted to secure optimal tenants mix. Next page. This page shows our rising VIP member base. Our store places a great value on the continued support of our VIP members, whose contribution to total sales is more than 60%. Currently, we have a basic, gold, and platinum membership based on the amount spent. So as of first half 2024, the total number of VIP has reached 3.8 million by the end of second quarter 2024, and the 3-year CAGR is 90%. Both Chongqing, Liangjiang, and Hefei account for around 64% of the total membership. At Liangjiang, there were 1.3 million members, while at Hefei, there were 1.2 million members. We will continue to foster member loyalty by providing attractive discount to Platinum and Gold members. Next page. This is the page that the AEI work that we have embarked on at Kunming since April to enhance the leadership position of Kunming outlet. So the capex amount is around SGD 244,000. The space undergoing AEI is about 11,000 square meter, and this AEI is expected to be completed by end of this month. So what is the objective of this AEI? The first one is to meet shoppers' needs, address evolving shoppers' needs by optimizing the layout, product placement, and shoppers' flow. And secondly, improve appearance and functionality, enhance the overall aesthetic and functionality of the store layout to create an engaging shopping experience. And last but not least, enhance our trade mix cluster. Grouping similar trade mix together help us to make more informed decisions about inventory and assortment planning. In this instance, basement 1 was converted to sports team zone and level 3 to super kids zone. Next page. So this page shows you some of our exciting new brands and upgrades in 2Q. For example, young and trendy brands in Hefei like Ben Under, and then this Kunming outlet Gowani. So, and of course, we have some new food and beverage brands like KFC, Starbucks, and Luckin Coffee. Next page. These are some of the activities that we hold at our outlet mall. For example, in mid-year sales on the left-hand corner, and then we have Dragon Boat Festival and the Labor Day holiday, which China was on 3 to 4 days on a week-long, day-long holiday. Next page. Okay, with this, I'll hand over the mic back to Cecilia.
Thank you. So this will be the concluding segment, and later we would make time to answer some of the questions in the pigeonhole. Clearly, I think the China story has been in the media for a long time, right? Since COVID and then the property crisis. But clearly, I think hopefully the worst was over relating to the pandemic effects, and now China would be going towards, I would say, stabilized growth, in the next few years. And obviously, I think some of the economic data that come up from China in the last few months has been rather choppy, I would say. But nonetheless, we continue to stay focused in driving consumption. And this is also where, particularly the third plenum meeting that just concluded, there is a very clear focus at the government level to continue to try to drive domestic consumption as really the more fundamental engine of growth. pivoting away perhaps from the property and trying to reduce the reliance on property. And I think in a way that will set China on a healthier path of sustained growth going forward. So as you know, China has already taken some steps to try to really make the whole economy more vibrant. First thing first, they try to sort of drop interest rates. I think this is a very, very clear signal that they continue to try to make businesses more viable, make the whole cost structure lower. And of course, from our perspective, like what Tianfeng has shared earlier, we feel that we're going to be a direct beneficiary of this, given that we have a greater proportion of China debt, and that will continue to help us sort of lower the cost structure for the REIT, and hopefully giving more scope for DPU expansion in time to come. So all eyes in terms of what we can expect, how the China government is going to continue to roll out strategies for the next 6 months. But I suppose when we come and look at China, we cannot sort of see them in isolation. We really need to put our eyes in terms of the long-term demographics and long-term fundamentals, because we are outlet and we are really a proxy for consumption growth. We look at a few factors, and in fact, we have taken some guidance from McKinsey. I mean, McKinsey has a very big franchise in China, and they monitor the consumer market quite closely. So interestingly, from the report that we shared here, is that China is now the home to the largest middle class cohort in the world. Okay, no doubt India is coming up very nicely, but China being still ahead of India, I think this is also important because our target market base is really the middle class, where they have a greater propensity to spend on family needs. And we also the trend of consumer being more cost conscious, actually we saw that already way back in 2023, and that continues to 2024. So I think with that, as it is, outlets already have the natural advantage of value proposition. What we're going to do in relation to this trend is we're going to continue to sharpen that value proposition, which is why we continue to invest in our outlets for them to stay relevant and stay competitive. For example, the one that we just mentioned on Kunming outlet AEI. So with that, I go to the next page. All right, just a glimpse. Usually, our promotions are really all year round, but I would say typically the second half of the year, we tend to have greater promotions. Couple of things there is the signature anniversary sale. So this is like a mega promotional event across all sassuer outlets, which is all the 17 outlets will have their anniversary sales at different point in time, starting from September, and then will flow over to October. So we do expect this to be a big booster to sales. And of course, towards the end, the usual REIT Festival. REIT Festival is actually really, we are seeing a very big trend now in China of local brands taking more and more prominence with consumers. And also a lot of these local brands, really the quality and the price point is really very competitive relative to the international brands. So they are also capturing a larger market share over time. And of course, the year-end promotion. So the other thing is also in the second half, because of the seasonality factor. One is retail seasonality, one is, I would say, weather seasonality. In the second half, where when we go into autumn and winter, we tend to sell higher price fashion clothing. So that will also be something that we hope to lift up the sales in the second half. Right. So you can see we have all mapped out our strategies for the second half to come. So with that, the concluding slide is really we're going to continue to stay focused in where we see how we're going to drive growth and unlock value for unit holders. Okay, in terms of asset management, and this is going to be a bread and butter. So continually, we continue to harness that by really trying to go towards where we see consumer trends telling us, and investing, in a very strategic and in very intelligent way to make the portfolio be more resilient and be more relevant. In terms of capital management, Tianfeng has outlined to you, actually, we are really on the path of trying to take advantage now of we seeing up the liquidity in the Panda bond market, and also hopefully with US Federal Reserve starting to drop interest rate in September. That's why all eyes on there. That will also be a good sign for us, because as we move towards the refinancing of our major loans in 2026 onwards. And of course, in terms of expansion plan, we continue to tread this quite carefully in relation to taking note of the current market environment, and we will activate this when we feel sufficiently ready. So I think time check 106, I think that should leave us sufficient time to address the questions in the pigeonhole. I saw quite a few already put up there. So I hand over the time now to SGX. Okay, so I understand that we have a few questions here right now. So actually I noticed there's been quite a few of the finance questions. So maybe Jianfeng, you want to address the finance questions first, because I think those are probably quite interesting for many unit holders.
Yeah, I've seen one question is about, do you plan to reduce your offshore loan exposure? It still seems quite high given your revenue is renminbi and your PR rate is quite declining. Yes. So what actually we are trying to do is to get more renminbi exposure rather than offshore borrowings. Say in the upcoming sponsor loan to be mature in March 2025, we are trying to use a renminbi borrowings to replace this. And also, I just mentioned we are trying to do sort of like the bond offering in China, which is we call it Panda bond. That's actually it's really cheap. I just mentioned the capital land and also the Shangri-La 2.5% per annum and 2.8% per annum. So coupon rate. So actually, we are trying to use more of these sources to replace our existing borrowings. Maybe we can consider to repay our 2026 maturing offshore debt if situation permits. So that's something we are just trying to do right now. Yeah.
Jianfeng, why don't you just finish the finance questions, then later we can go to
Yeah.
the other bunch of questions.
Sure. Okay. How are you plan regarding the currency composition of your debt? Will you raise the renminbi share? Okay. Maybe Cecilia, you can refer to this question.
Okay. Sorry, where is that question? The question is regarding the exposure of the renminbi loans, is it? So we're trying to toggle the
renminbi shares.
Yeah, the plans regarding the currency composition of the debt. Jianfeng, you want to take that, or I can answer that?
I think I've already talked about this already.
Okay, I think if this is addressed, then maybe we can look at the other finance questions. I think there's one interesting. It says the REIT has loans in renminbi, Sing dollars, and US dollar. As all properties and revenues are in China, what is the reason for not having 100% debt in renminbi?
Okay. So actually, you understand that from when we start IPO in 2021A, there's actually the offshore debt is much cheaper than renminbi debt. So from the longer timing, if we look at long perspective, actually the offshore debt is most of the time it's cheaper than renminbi. So we just cannot just change it in one go to replace all the Singapore dollar offshore debt with the renminbi. We also need to look at the trends in the future. In the meantime, we also need to keep a good relationship with all offshore banks. So in that case, we cannot just simply replace all 100% to renminbi.
Okay, so in short, there was also a legacy structure that we have to deal with. But clearly the intent, as Jianfeng has outlined, we are hoping with the current market environment and lower interest rate in China, that will create really the right opportunity for us to refinance some of the offshore into renminbi denominated debt. Okay, I think there's also one question that talk about your hedging policy. Maybe you want to talk about interest rate hedging, currency hedging, Jianfeng?
Okay. So for the interest rate hedging, I just mentioned we hedge 87% for all our borrowings. So I don't need to repeat it. In terms of the currency hedging, actually managers are proactively to manage the currency risk. First of all, we have the natural hedging because we have a China renminbi debt we just talked about. This poses a good natural hedging regarding our currency risk. Apart from that, we also hedge the renminbi repatriate from the China to the offshore for the repatriation. So our hedging policy is about 30% to 100% of the total renminbi exposure. However, given the current volatile situation, we actually hedge around 90% this time for the September distribution. And also we have started for the 2025 distribution, the hedging already. Yeah, so that's what we have done.
Okay, I think the last finance question I saw was the guidance on interest rate. And Jianfeng, I know this is a bit crystal ball gazing, but from your perspective, what do you think?
I think because currently our interest rate is 5.3% per annum, and we expect it will be further drop because China and US are on the path of lowering the interest rate. But regarding how much further it will depend on the September the US Fed announcement of the interest rate cut, and also it depends on the Chinese government how they do to decrease the interest rate. So we can wait and see, but definitely the trend is down on the downward. Yeah.
Okay, thanks, Jianfeng. Maybe we can address some of the asset management questions. I see a few. Let me just take one. Okay, there's one. Xingyuan is talking about the lease. The WALE is very short with 2.1 years. What rent changes? Yeah, okay, it's up. Do you experience and expect when renewing the leases?
Okay, our lease is short, as I explained in my presentation just now, is because we want to attune the changes we want to align our trade mix according to the consumer preferences. And then, of course, maybe I just explain a little bit at length is that we actually, more than 90% of our leases are signed on turnover rent. What does that mean? That means that for the rental that we receive, we take a cut of the total sales that has been achieved. And the cut is between 10 to 16% on the average. So therefore, if you ask the question on what rent changes do you experience, so far during our renewal season recently, we didn't see a change. The cut, that means the percentage of the turnover rent remains relatively stable. So I hope I have answered your question.
Okay, thanks, Xingyuan. I think another question is interesting. Maybe I would like to answer this. What are the key differences between outlet malls and conventional retail malls in terms of business models and leasing practices?
So Cecilia, I want to answer.
Yeah, you can go ahead and answer.
Sure. Okay, the key difference is that more than 90% of our leases are contracted based on rental derived from actual sales, which is very interesting feature that differs from most of the conventional malls. The majority of these leases pay little fixed rent or no rent. This is true alignment of interest between us and the tenant, and it is very powerful. It is in our interest to help our tenant to do well and drive sale. This is how we continue to chalk up our sales and boost our rental income. Another key difference would be our short WALE, as we have explained previously, usually not more than 2 years. The short WALE allow us to adjust the trade mix quickly, aligning swiftly to fast-changing consumer preferences. Then for conventional retail malls, generally they have longer leases ranging from 2 to 3 years or even longer. They typically use fixed rent model whereby tenants pay a set amount regardless of sales performance, with less flexibility in terms of negotiation. Thank you.
Okay, cool. Let me just address the rest of the questions. So I'm not seeing my pigeonhole. Yeah, okay. I will just okay. I mentioned beginning sassuer group is not a developer. Now this is very important because fundamentally their core capabilities is not a property developer. Now in the current property crisis, right, that has really impacted those businesses where they have property development at whether is it mostly residential or even some of them commercial. Okay, so because of that, they actually their core capabilities is actually in managing outlet malls. And in fact, if you can see from the way they run the outlets, it is very operational intensive. You know, we don't have time to go into a lot of details, but really the way they manage the outlet operations, because also the nature, the business where they take a percentage of the sales, it really requires them as an operator to really work with tenants to drive foot traffic and also run promotions. So the question, who owns the property? So it's an asset-light model, right? So I mentioned earlier, they now manage in the portfolio 17. Okay, minus the 4, which is already in sassuer. So sassuer is also have outsourced that management function back to sponsor, so they're managing on behalf of sassuer. They still have 2 outlets on the balance sheet, which they own, Xi'an and Guiyang. So the 11 outlets, I would say, some of the outlets, they do have joint venture structures, meaning to say they have partial equity stake. Okay, but I would say that majority, the structure they have undertaken in the last few years is that they would look at the property, particularly in an area that they don't have representation. They will enter into like a 10 to 20 year master lease. So they become like the master tenant of the property, but the property is owned by a third party, not owned by them. And then what to do as a master tenant, they start to bring in their own brands, and then they operate, and you know, the subtenants, which are all their brands. So this is how they have moved from a sort of the previous strategy where they have to go and buy land and build their own outlets, to now the SLX strategy of really just operating outlet, including, you know, operating third-party outlets not owned by them. So I hope some of that also gives some clarity on this. If I could ask SGX go to the next question. Okay, what's the rationale for changing management fee structure to 80% in units? Yeah, actually part of this, right, has also been all the years we'll be collecting our management fees in units for 100%. In fact, we have now accumulated probably about 2% of total units under issue. And we have been receiving feedback, particularly from also institutional investors, that they like to see a structure where there is a slowdown in dilution arising from the issuance of management units. So if some of you are not aware, the more we collect our fees in units, actually it will continue to enlarge the unit base, and over time this may result in a dilutive effect. And so we also feel that that is probably not a very sustainable strategy going forward. Because if you're not aware, some REITs, right, they have a very high holding of their management fee structure, and meaning to say at some point in time, those fee structure, they need to sort of deal with it, right? So we feel that this is actually a more gradual approach to try to make the whole DPU profile more sustainable, and in a way is also better for us, that we can also continue to collect some cash back to ourselves to fund our own operations. All right, so I hope that will address the concern. Okay, the REIT has a history of retaining income, unlike almost all other REITs that pays 100% of income. Can you share how this retained income was used in detail for the benefit of shareholders? Oh, for sure. First of all, I always feel, you know, as a responsible REIT manager, truly, I think when you pay 100% of income, you have a situation whereby that means the REIT doesn't have any, I would say, contingency buffer. And is this really good for the REIT? That's really something that I personally feel is not a very prudent strategy. I think you can only pay 100% income when you feel that, okay, the REIT doesn't really need to retain any cash. But in this case, we have started a process of discipline of retaining cash, because we really have a clear use for that. One of those things, if you didn't catch what Tianfeng was saying, for the renminbi onshore debt, right, they have a capital repayment schedule that we need to follow. And this is very peculiar for China loan, because this is the market practice. So a large part of that cash retention was going towards to repay the capital onshore debt. And you know, that is a partial repayment every year. But in a way, I think that also creates that financial discipline of us keeping the gearing at a very, very manageable level. So I feel that we will continue to practice some level of cash retention in order to create some level of contingency. I think this is also the right way of risk management for the REIT, where, you know, sometimes when the REIT meets with emergency requirements, at least the REIT is not faced with a cash crunch. And in fact, that will also goes towards enhancing the credit profile of the REIT. Okay, I hope that will answer the question for this. Okay, China yields high employment rate retrenchments among middle income, which are key to consumers. REIT has also seen falling income. Does the REIT see the worst is over or yet to come? It's really hard to say, but I would say the worst was over for China when it comes to all the pandemic related. I feel China is going through as they try to do a economy restructuring. Certainly they are going through some level of pain, and of course is worsened by the property crisis that has been already at play for a few years. So I think all eyes are really on the government in terms of how are they going to try to stabilize the property market, because in a way, the collapse of the property market, which is in a very big way, has resulted in a lot of spillover effect to other businesses in the value chain. And that also has put pressure on employment situation. And also, to be honest, we also heard, some of even the state-owned companies and some companies cutting back hiring and also pay cut. So I think the whole country is really trying to cope with the new economic environment. But I think China still presents some very long-term fundamentals. I think we also need to put in context, even at 5% GDP growth, right, on a very, very large economy, that's actually very, very overwhelming. I mean, recently Singapore just upgraded our forecast to 2 to 3% on such a small economy. So, as it is, we are trying to inch up to anything above 3 is a big challenge. So we need to sort of look at that in context. Now, in relation to the REIT, how are we going to respond to current consumer sort of purchasing patterns? Again, we tune that through the brands that we bring in. We tune that by trying to increase the discount and continue to create that very clear value proposition and become the destination point for consumers looking for really bargains and not having a big compromise in their lifestyle. So this is where we are trying to respond to the market opportunities. And I think, is it the last question? Or last two? Okay. When can we expect the first property acquisition by the REIT so to spread the risks? Yes, I know this has been highly anticipated. I would say we are still working on it. The timing is, I really don't want to commit to it. When we're ready, we will launch that. But suffice to say, you can see that one of those things we are getting ready is really the capital side of things, because capital drives acquisition. Without certainty and clarity on where we're going to get funding, I think the acquisition plan is not going to happen. So wait for us. Hopefully in the months and to come, we will give you more clarity in terms of how we are progressing on this front. I think the last question, if I could take the last question, how did the Olympia sales program go? Xingyan, you want to add more color? Although I think this is quite a small promotion, if I'm not mistaken.
Okay, yeah. This one is our cash register was actually running quite fast. That means the sales was actually doing quite well for this impromptu Olympic sales because of Olympics. So the operational team right on this Olympic fever to have some promotion for sports, a lot of sports product and outdoor apparels. So in Hefei, Kunming, and as well as Liangjiang, it was doing quite well. So this also reflects how innovative and creative our entrusted managers are. They will tap on whatever opportunities to promote sales at the outlet level. I hope that clarifies.
Yeah, thanks. I think we are good with time. We still got 5 minutes. Anybody still have like some last burning questions? Feel free to throw that in the pigeonhole. But while you're sort of thinking about the questions, again, the call here is China obviously has been very much, to some extent, everybody has a different opinion on China, but hopefully through sassuer REITs, we are demonstrating to you. In one of these things that I saw recently, DBS issued an updated report. I really like the headline. They say strong stewardship amidst rough seas. Yes, this is what me and my team, we continue to try to deliver. Amidst the rough seas, we try to find an anchor to continue to stay stay firm in delivering stable and sustainable cash flows to our unit holders and also maintaining growth in NAV over time. So for those unit holders who have invested in us, thank you for your confidence. And for those listening, you have yet to become our unit holders, hopefully through this presentation, it will give you a lot more insights and hopefully confidence to start the investing journey with us. So, that would be sort of my closing remarks for all of you. Yeah, okay, let's see whether we can play the video now as a closing treat for everyone. Okay, Jeanette was still not getting the sound. Okay, no worries, everyone. In fact, the slides that you see today, we have already uploaded on our website, so you can go to our sassuer website to download this set of presentation slides. And in fact, on our website, you can also see the YouTube icon, and you can also go to the YouTube to look at some of the videos that we have been uploading. In fact, we have quite an active social media platform in LinkedIn, and also we have Telegram. If those of you, please do follow us on Telegram so you can see some of the regular updates we provide, not only on sassuer, the outlets, as well as on the sponsor. All right, so I think with that, we can come to the close of today's webinar, and thank you so much. I see really, we had close to 50 people listening in. Thank you so much for your interest. So I hand over to SGX. We will close this webinar. Okay, yes, thank you, and have a great day ahead as in the chat. Thank you.